Are you a freelancer and wondering what you should be saving for your tax bill? Well, watch on and I'll tell you just that. As a business accountant, my team and I spend all day long helping freelancers on their business journey. And as a result, we often have the question, how much should I save for tax? Now, the first thing I have to say about this answer is it's so dependent on your circumstances, but there are some key rules I think that have served us well over time, and they're what I'm going to share with you now. So if you've got an accountant, definitely go and speak to them. If you haven't, if you follow these rules, you should have the tools you need to make sure that you have generally a decent pot of tax set aside for when that bill comes. Before we get into the detail, if you do enjoy these types of videos, make sure to click the subscribe button below so you get notified every time we release one of these videos. So let's start off with the basics. First off, there are two different types of trading that you would normally do as a freelancer. One is as a sole trader or a self-employed person, and the other one is a limited company. Both pay their tax slightly differently, so I'm going to break those down into either one. So let's start with our sole trader. So your sole trader, so again, that's just basically anybody that's not a limited company, you pay personal tax. Now, one golden rule that was told to me many years ago, which I still think stands the test of time, is make sure that you save 25% of your profits in your bank account. Now, that's not necessarily turnover, not the money you get in, although if you want to do that and can afford to do that, great, you'll have plenty of tax saved. But sometimes as a freelancer, if you're labor only, that is pretty much all of your profit. It is your turnover, but you're really looking for 25% of your profit and store that to one side. Now, 9 times out of 10, if you're earning under about 50 grand, that's going to be more than you need. And actually, what was told to me is you can go on a holiday with what's left. So there is a bit of a nice feeling, I think, when you come to it, you get your tax bill and then you can pay down your tax and then enjoy the rest. But 25% it seems to work quite well for both your national insurance and your tax. The thing to bear in mind is if you start going over 50 grand, or the closer you get to that, sometimes 25% is not enough, and that's just because your national insurance and your tax can become vastly more. And quite often as a sole trader you have to pay twice a year and some in advance, and that's where the 25% normally works really, really well. But yeah, as you start getting up into the higher earning brackets, that doesn't work as well, but then normally you'd have an accountant shouting at you, go limited, you'll save some money, and that's a whole nother video that is on our channel. And that's probably a good segue into limited companies. So sole trader is very, very straightforward. Limited companies, you've got two types of tax in play. You've got your corporation tax and your personal tax. So your corporation tax, your company pays 19% at the time I recorded this video on your profits. So again, if you leave 19% in your company business account of your profits, you're going to be fine. It's really, really key to remember that to do that either way, at least 19%. And the reason is that with a company, you can actually have issues with what they call overdrawn director's loan accounts, and that can cause you a further tax problem. As a sole trader, you don't have that. It's all your money. If you've shorted the tax man and you've taken it all and you need to pay him back, well, that's your problem. With a company, the company has an obligation to pay that tax first and foremost, and they will levy like another holding tax basically if it goes wrong. So just bear that in mind. Again, there's another video on that particular topic, but for now, if you stick to 19% of your profits in your company, you'll be fine on that end. Then the other thing to bear in mind is when you take out this money, and again, we're presuming in this scenario as a freelancer, every freelancer I've ever met is the owner and the director, so the shareholder and the director of the company, so you can take out dividends. Now, if you're taking out dividends, that's cool because that's super tax efficient. However, it does have a personal tax bill now associated with it. Going back many years ago, they didn't, but now they do. And generally that tax bill is about 7.5%. What we normally say to people, especially if this is your first year, is save 10% of whatever you're then drawing out of the company. So you're leaving 19% of your profits in the company, and then whatever you decide to take out afterwards, save 10%. Now, it should be way more than you need, presuming again you're earning under 50 grand. But again, that first year when you have to pay, if you earn enough money to pay over £1,000 of tax, then what's going to happen is they're going to want it in 2 chunks up front for next year as well. And the first year that happens, it can be quite a cash flow drain. So if you've got that 10% saved, you should be in a really, really good position to be able to field those tax bills and make sure that you've got enough. Of course, if it's too much, then that's great. You can go off on holiday or do what you want because that money is now yours. It's out of the companies and you can do what you'd like with it. But I think that's a good rule of thumb. The alternate way of doing that is a limited company. That happens with quite a few freelancers that have got regular income. So you find after a while that you might start to almost pay yourself what people would term a wage. Now, it's not a wage because normally in a freelancer scenario, it's going to be some dividend and some salary, but it's going to feel like a wage to you. It's a regular monthly amount. And when you get to that sort of stage, you've done a year, you've seen your tax bill, you're getting around the second year and you're already taking the same amount of money, people then start to go, well, okay, well, I knew my personal tax bill was about 3 grand last year, so this year I'm just going to save 3 grand as the year goes on. And that's okay. And again, even if it's not quite right, it should stand you still in a really good place with a pot of cash to be able to deal with any of those tax bills that come in. Of course, allowances do change year on year. You could have other things coming into play, like, you got yourself a part-time job during coronavirus and that threw out some of that and all the rest of it. But generally, again, you're looking to be in a position where you've got some money towards your tax. I think where people get themselves most in trouble is when they don't save anything and they think, I'll earn it later. And then things happen, contracts get cancelled, etc., and it all goes wrong. And unfortunately, every year we see people that drain that company. So they've got overdrawn loan accounts in the company. They can't pay their personal tax, and it feels like an incredible debt burden. So just bear that in mind. They're amazingly efficient things, limited companies, but you do need to save. And on the flip side, going back to your sole trader, it might be amazing enjoying all this money every month, but those people in employment, and you will remember this if you've ever been employed, you didn't get to enjoy that tax money. It got deducted at source from you. So now let's be sensible and keep a nice little savings pot to one side. Quite often, one of the best practices to do that in either is you could have a reserve account on your business bank account. So it's normally like a free savings account that the banks will give you, and it just means you can hive away some of that tax money into those accounts. And a final one, just to mention on the limited companies, as we spoke about, there's a couple of taxes involved there, and I think and also there are some quite hefty consequences to getting that wrong. So I'd always recommend when you're looking to work with an accountant that you work with an accountant that can tell you often what that corporation tax bill and or the personal tax bill is looking like, so you've got enough money in the company to deal with it all. That's it. So hopefully you've enjoyed this video. If you have found it useful, please do share it with your networks, comment below with any questions or get in touch. We'd love to chat with you. See you on the next one.